Good afternoon, this is Bill Riley with Riley Private Client. Today's topic is going to be the halftime report. As you're well aware, we're coming up at the end of June, so we've had 6 months of this year that will be behind us, and hopefully I can kind of talk about what I see going forward and what I expect. When you think about it, you got to think about where we are and what does a double-digit gain in the first half of the year mean for the second half. As kind of a historian on the markets, I went back and gathered some information, and I'm going to go through it with you. And maybe we can maybe get a little bit of a feeling about where we should be and where we're going. But we also must remember that we're coming off a very unusual time in the market. There's a lot of things going on that we really don't have a lot of, let's say, base facts on of what happens when this happens. So let's talk a little bit. As of Tuesday, and there's just about 3 trading days left, 2 days actually, the S&P 500's up about 12.3%. Now, used to in the old days, that was a good year. So now we've done it in half a year. So there's always this fear that we're so far up, maybe I should be, raising cash or maybe stepping aside or, just getting a little nervous. And yeah, that's a normal reaction because really, if you were up 12%, it had a good year. But I think we're still going to go forward, and let me give you some statistics on that. Our question is how much gas is left in the tank? Well, let's look at it this way. The question always rises, are we overbought, oversold? Are the valuations too high? Or, is it time to raise cash and get out of the way? But let me kind of give you something here. As it turns out, however, that historically, where we've had these type of years, where we've had these markets moving up this fast in the first part of the year, it really means we're going to have a pretty good second half of the year. And history will tell us that. What I'm going to go through is that it's found that since 1928, that when the S&P returned 10% or more in the first half of the year, the second half of the year, we had returns on the average of 6.9 to around 10%. Now, why does that happen? A lot of it's just momentum. A lot of it is because the economy is getting better, which we know it is. And this year it really is. So things go forward. So you really can't say, well, we're up 12%, maybe I should lighten up. That really has nothing to do with it. Markets are pretty insulated from our behavioral type viewpoints. So, let me read you something here right out of FactSet so you know it's not just me. Given the outside gains of the second half, we should expect for the second half, since 1928, there have been 26 other years where this has happened. And 77% of the time, the market has gone up, on average, 6.9 to almost 10%. So what does that mean in real numbers to us today? Well, the S&P is at about 4,200, and that's what I really watch is the S&P 500. That means if we get a normal rebound or a normal continuation, that the price objective could be around 4,500 from where we are now. And if things really went well, and it could with the rebound in this economy, history tells us we should be around 4,600. That's pretty good. And that means a lot of problems that we had last year have been erased and we're going forward. Now, we've got a lot of things to deal with. We've got some political things that are just sometimes very confusing to me. We approve something and say I'm fully behind it, and 2 hours later, a statement's made that, well, I'll do it if you'll do this, and I won't do it unless you sign this. And then we have a retraction of that. So we've got a lot of confusion going on. But in reality, the market kind of likes that because the do nothing is what I call it. Government, usually markets say, great, let's move forward because they can't get anything done. But the infrastructure bill should be something that could help a lot because it would put money back in the economy, create a lot of new jobs, and make things a lot better than they are now. So my projections may be a little off, may be low. Now, here's something to think about. In 2019, at this point in the year, this is before the great pandemic, we were up 17%. For the remainder of the year, we were up 9.85%. That resulted in a return of almost 28% in 1 year. I went all the way back to 1975 when I was quite a young guy working in these markets. In June of 1975, we were up 38%. We finished out at about a little negative 5% because the market had moved very, very fast. But that still gave us a return of somewhere around 30-something percent. So even though we may have a little slowdown here and there, and I expect there will be some corrections over the next 6 months, maybe 5, maybe 10%, but they'll be quick, they'll be fast, and they'll be reactive, is what I call it, to information that we really can't figure out how it's going to really affect the market. So the old adage is, when in doubt, stay out. So you'll see some of that. But I still think by the end of the year, we will be about where I'm thinking, around 4,500 on the S&P. So let me tell you some things that I'm thinking about and I'm trying to get in my mind about how things are and what's confusing. I believe that we're going to have more of these what we'll call taper tremors. That means when you're going to hear the Fed speak, you're going to have part of them say they think they should raise rates sooner. You're going to have some of them say, no, we're going to wait. They may be talking about slowing down on the bond buying. That's kind of like adjusting rates, but I don't think it'll stop the market. I think the market's already kind of baked that in. They assume it's going to happen. It probably should happen. Because one of the things that I can't get in my mind, but if you look back historically, why is the Fed still buying bonds at these low rates? What is the purpose of it? Why are they doing it? And that is something that's a big question in my mind. We've had a 20-year decline in interest rates caused by slowing economic growth. And that's really what has happened. The aging populations and more risk from the aging, all while corporations are de-risking their personal liabilities. They're lowering their debt, cutting their debt. Now, real rates are also negative. Really, if you buy a 10-year treasury this afternoon, and it's around 1.5, effectively, if you have 2% inflation, you have a negative rate. So why is the Fed still doing it? That's a big question in my mind. I think they're doing it just to give us confidence that they're there and they got to do something. They don't want to raise rates, so they cut buying bonds, which keeps rates where they are. Now, let me point out something. There's things called TIPS, Treasury Inflation Protected Securities, which are used a lot for people that are, a little nervous. They just want to buy something, but they know inflation could go up. And what they do is when you buy one of these, they're a bond issued by the government, that if inflation goes up, their rates go up. So back in 1997, TIPS were selling at about a 3.5% yield. Not bad. Who wouldn't want that today? And in 2000, they went to 4% in a year that we had the tech wreck. Now that's extraordinary. That's very off what it should be. But now, what's interesting is they're at negative 8%, the effective yield on a tip. So when you hear people say, we should buy tips, you should buy tips, you're kind of paying the government for buying a tip. So there's a lot of confusion here. I really don't understand why they're buying bonds other than to give us confidence that they're doing something. The long-term and patient investor who can hold equities over a similar 10-year period will be far more rewarded than buying a 10-year treasury or a tip. Because if you go back and look historically, the market has never lost money over 10-year rolling periods. And that's very easy to Google and look at. Where do we go from here? I think we're going up. And I think it's going to continue unless something comes out that we really don't see. I don't think the administration is going to get a lot done. I think they'll get the skinny bill, I call it, passed, and we'll pump some money in the economy. So all we can do is wait and see, stay with our allocations, but be ready in case something happens. Well, thank you very much. Hope you enjoyed this and got some information from it. You can always call me at 817-870-4680. You'll also see on the screen our email, and I would love for you to send me some questions. So right now, let's stay the course, see what happens, and find our opportunities. Thank you very much. This is Bill Riley, and I'll see you on the turn.